Knowing the capitalization rate helps you in your journey in the real estate investing. Just makes it that much easier and makes transactions that much smoother. Now, you can ask for others what is the cap rate, ask around other investors, or you can just come up with your own cap rate yourself. And in this video, I'm going to explain exactly what it is, and I'm going to give one secret sauce, little trick on how you can hold your own property at zero cost if you know how to get this cap rate. By the way, if you have your own first property already or not, if you're just starting out and you would like to be in your first property, either you own it or you're renting it, let's say you own it in the next 3 months to 6 months. If that's what you want to do, and you want to get into it without too much money out of pocket, then I've created the perfect thing for you, totally free, just my way of giving back. It's what I wish I had when I was starting out, and it's exactly how I did it. I got into my first rental arbitrage for just $10,000, my first real property for about $23,000. And these were big properties, like $500,000 properties in good areas. So you can too, and if that's your goal, if you really would like to get into a property in the next 3 to 6 months, even in this market, then there's so much information that's provided for free. Just click below and you'll thank yourself afterwards. So in terms of cap rates, the basic intuition is that the cap rate or capitalization rate is simply your take home from your rental divided by the purchasing price. So as a ratio of the purchasing price, if you will. Now your take home is like your revenue minus your expenses, all your income minus your expenses in holding the property, right? So it's technically the net operating income, or NOI, divided by the purchasing price. So what we would like as investors is we would like, of course, our net income to be pretty high, right? We would like that over that top line, that numerator, right, to be bigger. So the cap rate would be bigger for us. Or alternatively, we like to buy cheap. We like the purchasing price of the home we're buying to be low. So for that reason, we would like a high cap rate, especially if we're investors, we're buyers, maybe we're looking for cash flow. High cap is typically, all else other considered constant, it is typically good. That's what we really want as buyers. On the seller's side, it's going to be flipped, right? It's going to be the reverse. For them, they're trying to sell their property. Sure, they've enjoyed the income, but they want to get a good price. So they want that denominator, the number on the bottom, that purchase price. They want that to be big. They want to magnify whatever they're getting, their income minus operating expenses. They want to get that, and they want to then take a bigger multiple to multiply that into their price that they're going to get, they're going to receive when they sell the home. So they want a low cap rate. So buyers, we want high cap rates. Sellers, they want low cap rates. So we might be willing to come down and they might be willing to come up, and hopefully we can intersect. And if we can, we can do a deal. That's just the way it is intuitively for buyers and sellers. But, maybe you want to just scratch the surface, or maybe you want to go a bit deeper. What exactly is the cap rate? Well, you can come up with it yourself, as I said, but definitionally, the cap rate is just the net operating income divided by the purchase price. What is the net operating income, you might ask? Well, glad you asked, because that's a bit more detailed. So the net operating income, again, just think about your take home. So it's what's known as the effective gross income. This is all income. It's not just the rents. Maybe you got a 1-bed, 2-bed, 3-bed studio, etc. Not just the rents. Maybe you're renting out garages. Maybe you got a coin-operated laundry that you have. Maybe you got vending machines, for all I know, right? Whatever it is, all that income, right? Adjust for vacancies. And by the way, you can look at your past records of the owners that own the property. You can look and see what happened last year. But you could put a 5% vacancy in. That's a usually good rule of thumb. So take all your income and then just look at 95% of that. Or you can look in the local area to sort of get an idea of what the vacancy is in your area, your district. Now, they also adjust the effective gross income, move it away from potential. That's if it was 100% occupied, but we know in the real world it's not. But they also adjust it for things like credit loss. Now, this is the idea that, maybe the actual tenant paid late, maybe there was non-payments, things like that, where, it's a bit of a problem. So credit loss, probably less important to look into, but if you look into past records, you'll get the exact data, as opposed to what the owner or the seller is telling you. You want to trust but verify. So trust the numbers, but double check. So look at the last year's records, right? That way we get the income, all the income, the effective gross income for the property at the yearly rate. Now we want to subtract the operating expenses to get our net operating income. So what are the operating expenses? Well, this is not our mortgage. We're not looking at debt service in particular, so not the principal or the interest. Imagine you owned the property mortgage free. You had it outright, you had no more mortgage. Well, you're still going to pay your taxes and you're still going to pay your insurance. And in fact, usually when you have a mortgage through the escrow, taxes and insurance are also paid. They're serviced through the escrow, along with the principal and the interest. But you still have to pay taxes and interest, so that's the first thing. Now you can easily get the taxes typically. Look up an address, the property you may be interested in, or just a general property in your area, and have a look at what the taxes are. You can see on Zillow, put in an address in Zillow, you'll find out, let's say it's $10,000 that the taxes were last year. So that's about $866 a month, for instance, in taxes. It could be much higher, it could be much lower, depending on the property and the district and what they evaluate the property based on, the tax records. There's also the insurance. Now, you can ring around, you can ask an insurance agent, but what I like to use as a rule of thumb, for one door, I typically think of, that's about $100 a month for insurance, especially if you're renting it out. Now, if you've got multiple doors, let's say it's a duplex, that's $200, 300, 4 quadplex, $400 per month on insurance. Again, that's just a rule of thumb, but you can go and you can actually ring up your insurance agent and you can ask them to give you a ballpark estimate for the insurance for that property. You can also get information from the seller if the seller has past records of that. You can also get maintenance. So maintenance is the next thing. You want to also subtract maintenance. So maintenance, a good rule of thumb, just repair, could be something like 1% of the value of the property. Now, if it's a really new property, it might be as low as 5% of the gross rent. So look at the gross rent, take 5% of that, and that's usually, so if you're renting a property, let's say for $50,000 a month, maybe $2,500 a year, or about $200 a month is your maintenance. Just odds and ends, minor repairs, things like that. But you want to have that set aside. Management. Now, you might manage it yourself, and so you don't have any management fees, but you do want to pay yourself some kind of salary. You don't want to work for free. So typically look around the area. Maybe it's 10% for management, higher if it's more short-term, lower, more long-term, depending on the actual property management company. It can vary quite a lot, but you want to adjust for management. Utilities. This is something that can vary quite a lot. So you do want to check what the last history of the last year would be in the property. Kind of difficult to do this, but what I like to look at is sometimes, up to about 100, like $75, $100 for like a single family, probably about $100. But realistically, when you're getting even to a quadplex, it's probably not much more than 150, 200. Now, this is assuming that we're handing over utilities to the tenants. We're not taking it on ourselves. Right? So maybe 50 to 150 is a really good ballpark, from kind of small, single, to maybe like more of a quadplex at the higher end when we're handing over utilities, because there's still some utilities and odds and ends. Now, if you're working on improving your finances and you're wondering what the next step could look like, I am hosting a free workshop that shows a simple, beginner-friendly path to buying your first property, even if you don't know where to start. If you want clarity instead of overwhelm, you can join using the link in the description. There's something that's a bit more controversial. It's not in the industry standard way of appraising properties. So, it's not the end of the world if you omit this. This is not usually what they use for valuations or appraisals. But if you're a buy and hold long-term investor and you want a real what is a real return on what I'm actually investing in, you might want to think of R for reserves. So this is all part of TIMOR, by the way, but the R for the reserves, this is different than maintenance. Maintenance is, general repair, but reserves, think about it like capital expenditures, replacing the roof, replacing the windows. Rather than fixing them like maintenance, you're replacing them. So think about 1% of the property value. That's a good ballpark for the annual reserve fund for your property. Now, you can also make sure to think about having a 6-month reserves of your expenses. But if you're just trying to ballpark this, again, not the end of the world if you don't include this, but 1% of the purchase, the value of the property, that's a good ballpark for the reserve. So you want to take this TIMOR, these kind of operating expenses, but you slip out the debt servicing. When you look at that difference between the effective gross income and the operating expenses, you're going to get your net operating income. And that's your NOI. Now divide by the purchasing price, now you have your cap rate. So the next question to ask is, well, what is your cap rate? Maybe it's you already know what the NOI is and you're trying to determine a price to offer. So, sure, they could be asking for something and that way you can get NOI divided by the price is the cap. But if you want to know what should you offer, which is typically the case, especially off-market private deals, right, where you want to give an offer and you want to see what's fair, then either you can ask in your area, ask around, see what other investors are getting. Higher caps are good for cash flow. For people who are in Class A neighborhoods, who are looking for appreciation, then you might look at more maybe 5 to 6%, as opposed to 7 and higher for the cash flow. And if you're a really high net worth individual here and you're just using the money, you're using the property rather to keep your money safe, and you're accounting for the depreciation, the tax write-offs, everything, maybe you can go even lower, right? When you're just looking for security. So maybe sub 5, like sub 4, even 3, 4, that kind of thing. But again, it's up to you what you want to do. Maybe you want to have a holding cost of 0. That's what I like. Now you might ask me, why, Michael? Why would you want a holding cost of 0? Surely you want to be making money. Surely you went into real estate to make cash flow. Maybe, but that's usually a beginner's thing, is to look for just cash flow alone. We'll see there's a lot more inside the iceberg under the water level, a lot more than cash flow. Cash flow is taxable, whereas a lot of the other things are not taxable. Right now, you see where we're going? So this is where that separates the truly wealthy. We're looking here at things like equity or appreciation. The market can go up. You don't pay taxes until you sell, so you just allow that to go up. So even if your holding costs, your revenue minus your expenses, right? Your NOI is 0, you're not profiting. Why would I do that? Because, well, you're holding the value of the asset. The wealth is going up, even though your income is constant. Your wealth is going up because you own the asset, because the market has raised the actual value of your home if you come to sell it. That's beautiful, right? Now you can also take lines of credit, a bit more advanced for this video, but you can borrow against the value of your equity tax-free. It's very easy to have good income when you've got a lot of wealth, but it's hard the other way around. So getting that wealth in terms of the actual market appreciation, but also forcing the appreciation. Either you throw on a fresh coat of paint, you do some fixer-upper kind of work on it, and you can add some value that way. That's forced appreciation. And again, you can do that while keeping your holding costs 0. You just do some nice stuff with it, and that's fine. Now, you can also raise the rent if it's a commercial multifamily. You can raise the rent, and that'll raise it on the income-based approach if you're looking to kind of get an RLOC, a rental line of credit, something more commercial financing. Now, there's other ways of doing things as well, like your tax write-offs. Now we're getting super duper advanced. So the tax write-offs, the depreciation, all that for a residential, it's like 27 and a half years. You can depreciate, not the land, but you can depreciate the value of the property, right? You can also do it a bit longer, like 39 in commercial. So, and for systems, it'll be 5 or 10, depending on the system. But these depreciations, they lower your overall taxable burden on all of your income across all your sources. So this is a really good secret here, that you look at depreciation as amazing, and also tax write-offs. So all these things happen even if your revenue minus your expenses is 0. So your tax write-offs and your appreciation, they're the two major things. Why that 0, holding it for 0, could be worth it. My goal is ultimately high net wealth. That's more important than income. So if I can get the net wealth up faster, great. And I can do that by having 0 holding costs. Great if it's positive, but I don't just look at positive cash flow. Now you can do it negative too. Again, you can carry it negative if you're in a really good appreciating area, or maybe you're house hacking, you're living there, but you're paying for your own rent, for instance. That's okay. Or, it just could be because you're a high net wealth individual, as I said, and you're just looking to protect. You want more asset protection, like money in real estate. So you could have a small negative carry. That's okay. As long as it's not like a massive negative carry where it's overtaking the appreciation, overtaking the tax write-offs and depreciation, then I don't know, at that point it's questionable. So how could you do this? How could you have a 0 holding cost? If this video is helping you understand this part of your financial journey, you'll get even more value from a free workshop I host for beginners. In this workshop, I walk you through a simple roadmap that shows how you can buy your first property with realistic savings and a lot less confusion. If you want to take everything you're learning on this channel and fit it into one clear plan, the link is in the description. It's completely free. So it's a really good trick, and we can look at this right now. So in this particular case, we're looking at the capitalization or cap rate, which is essentially the loan to value times a mortgage constant. If you want to have a zero holding cost, you can get this equation. Now, I'm happy to provide the details and how this is arrived at, but this is not a maths video, so we're not going to go into all the derivation for this, but this is something I worked out myself not so long ago, that if you want a truly zero cost, and this does account for debt service, so if you do have a mortgage, this counts for that, right? So if you're borrowing and you really want to make sure that, after my borrowing, etc., my principal, my interest as well, so it's going a bit further now, we're including debt service as well. If you want to have a true zero holding cost after paying everything, so all your income minus all your expenses basically nets to zero, then this equation holds. The cap rate must be equal to the loan to value ratio times a mortgage constant. We're going to get into that now. But what is the loan to value LTV? Look, if you put down, say, 5%, well, that means you're borrowing a loan of 95% of the purchase. So your loan to value is 0.95 or 95%. You've got 95% is a loan. The property is worth 100%, so it's just an extra 5 that you put down. Now, if you put down 10%, then the loan is 90, so it's 0.9. That's the loan to value ratio. So I'm going to assume in the example in a minute that it's a 95% loan to value ratio. You're putting down 5%. You can typically do these with multifamilies, with conventional financing, right, up to the conforming limits, and also for single families and things like that. Now, the mortgage constant, what's that, Michael? So the mortgage constant is this particular expression here, where we have the annual interest rate R. Let's say R is 6%. That's the interest that you're paying on your loan, your mortgage. And N, the letter N, is the number of years. So that's your annual interest, and this is the number of years that you have in your mortgage. So let's say you take out a 30-year mortgage, then N is equal to 30. R is equal to 0.06 or 6%. So this mortgage constant, if we multiply this by the loan to value ratio, we're going to get the cap rate that we need to go forward so that we can know, okay, this is my true cap. If I want a zero holding cost, that's what I want to do, then I know that every time that the Fed changes the interest rates or I get a new interest rate, I can plug the interest rate in, I know my number, and once the interest rate is constant for a while, I can go with this number, I can have this cap rate, and so as soon as I know the net operating income of a property, I can back out the price. Easy as that. I just divide the actual net operating income by this capitalization rate, it'll be a percentage, and that will give me the offer price. That, if I go above that offer, I'm going to be negative territory. If I go below that offer, I'm getting cash flow positive. So this is just your mortgage constant. Let's look at some numbers here. So if we plug in some numbers here that say the 95%, that's the loan to value. Again, we're putting down 5%, keeping our powder dry, and we're borrowing 95%. And we're getting a 6% interest rate on a 30-year loan, then what that equates to is about, again, you can put this into a calculator or these days AI, etc., Excel spreadsheet, you get 6.9 roughly percent. So my cap rate is just under 7, right? Just under a 7 cap. So it's 6.9%. If I take the net operating income, I divide that by the cap rate, I'm going to get a purchase price that I can offer. So let's say that I get a property and the net operating income is $50,000 a year. Now this is super duper, this is cool, but that $50,000, again, that's all my expenses and my income. So take the income first, include the vacancies, what was on that last year. Again, trust but verify the numbers, subtract all the expenses, my TIMOR, etc. Not my principal and interest, by the way, but it will actually allow for that. So we're not subtracting your principal interest, just the TIMOR, right? We've talked about above. Then we're going to get that number. So with the TIMOR, with the NOI, etc., we have NOI of $50,000. We've done all the calculation. We've got $50,000 for the net operating income. That's the hard part done, right? Once you get the NOI is annoying, but it's just the hardest part of doing this, right? And trusting and verifying it, because like the numbers, if you change them slightly, will magnify or dampen the actual end result. So you'd be really off. So you really need to be doing your best to try to get the NOI as accurate as possible. You need to get the income, and you can get the income pretty much 100% accurate. Unfortunately, with the expenses, it's going to be a guess. It's going to be a little bit off, but you want to be as accurate as possible, like really trying to minimize the error as much as possible to get your NOI. So again, if we have a NOI of 50,000 and we have, that's the net operating income. So we have the net operating income of 50,000. We now know that with the current interest rate of 6%, with my 5% down payment, right, I can get this particular result. So if the less I put down, the bigger the cap rate needs to be, right? So that's going to actually lower the purchase price. So the more I put money into the property, let's say the more, if I put more down payment, I bring it down to 90% loan to value, then I don't need as big a cap rate to break even. So the more money I put into the deal initially, I don't need to break even. But I don't like doing that. I have too much use for my money. So I like putting a small amount down. So again, with 50,000 for my NOI, I divide that by 6.9%. So 50,000 divided by 6.9%, I'm left with about $724,637, roughly speaking. So around about $725, you could say, is my offer, if that's what I'm trying to do, if I'm trying to hold at zero. So, you know, above that, I'm going to have to be comfortable with covering, being negative. And below that, well, great, I'm cash flow positive, hopefully, right? So the cap rate, again, this is the trick for zero holding costs. So now that interest rates the last few days, they came down marginally from 6% to 5.875%. And what that did is it brought the cap rate down from just over 6.9 to about 6.85%. Very small difference there, but an extra about 5,000. So now instead of 724,637, it's 729,927. So it's gone up a little bit more than $5,000 that I can offer just to hold my actual costs at zero, right? So again, that's pretty good, right? To be able to go up $5,000 just by a small reduction in the interest rate. So the lower the interest rate, the more you can tend to offer for this. So I don't know about you, I thought it was pretty cool. I thought, all right, knowing what my net holding costs, like holding costs of zero, including the mortgage, including all that stuff, all that good stuff, I like that, right? It's not guaranteed, because that's the risk in real estate and all these investing. But at least we know now a cap rate that's equal to the loan to value multiplied by the mortgage constant, where the mortgage constant, as we've said, is just the interest rate R, the annual interest rate, and we have the number of years of our loan N. You can calculate that, you can plug it in your cap rate, and now you can go forward and look and analyze multiple deals much faster. So now that you have your cap rate, it's all about NOI, right? It's all about net operating income. Once you do your underwriting, find out the NOI is, you can straight away plug it in. Just divide the NOI by the cap rate. Now you have your offering price. Now you can go forward, you can talk to sellers, and you have a much better idea of where you're at. Now, often the case is you're talking to sellers and they just want to know straight away, what's your cap? If their cap and your cap don't match, or there's no room for bridge, then you're probably not going to do a deal. But it's a real quick way of getting at, especially for multifamily properties, that I hope really helps. But again, you know, you can also do this for single family if that's what you want to do as well. So if you want to own your first property or the next rental property in the next 90 to 180 days, and you don't want to put down too much as well, then there's a great starter just for you for free, how I did it as well. It's exactly how I did it, and I really do help. It helps you get into your first property in the next 3 to 6 months or 90 to 180 days. Again, you don't have to do it all at once. Wealth is built one step at a time. So let's build your wealth one property at a time, and I'll see you in the next one.